Hello, Eric. How are you?
Morning, Ed. I'm good. How you doing?
Well, everything's good except it feels like winter. We got a big chill here, but we're not getting the snow. The snow is down south and in the Midwest, so we're dodging that bullet. How's it by you?
65, same as always.
That's nice. Been going for runs?
I have.
I wish I could join you. I need the exercise. Speaking of exercise, somebody who doesn't get any exercise is Max. Max is here again with us. It's a new year, 2025, and Max is still doing the same old, still chilling out. So we'll see if he wakes up somewhere along the way. Where's your puppy?
Yo-yo sleeping on his bed, hopefully for the entire call.
Good. They seem to be on the same wavelength. Eric, lots to talk about as the new year starts. A lot of different pressures on the stock market, but right now it looks like it was up on Friday and it's up again today. I think what happened on Friday is Microsoft announced that they're going to spend $80 billion on data centers and infrastructure for the data centers. So that is basically NVIDIA chips at this point, and then it's also servers from Dell and so on. So the technology stocks had a really good day on Friday, and they're doing it again today because this evening in your neck of the woods, well, not that close, but in Las Vegas, Jensen Huang of NVIDIA is going to be giving the keynote speech, the cheerleading speech, and everybody expects that the Consumer Electronics Show in Las Vegas that he'll be a keynote for will be all about artificial intelligence. So that could be pretty exciting. There could be some hype there, but there could also be some actually interesting applications. There's already evidence that that's happening here and there. So again, when we started talking about our roaring 2020 scenario in 2019, we didn't attribute that all to AI. We kind of mentioned AI, mentioned quantum computing, but what was more realistic back then was automation and robotics and other software that increasingly were increasing productivity. So this is just a continuation of what we've talked about as data processing. This is the digital revolution that started in the 1950s. And in the digital revolution is all about processing as much data as quickly as possible, as cheaply as possible. And we've made a tremendous amount of progress in that direction. And now we're dealing with AI. And before you know it, we'll be talking about quantum computing. Now, it's hard to see how you get these stocks down in the technology sector when all they have to mention is that they're making some progress on quantum chips, which is what Google did on December 6th, or Microsoft says they're going to spend a lot more on data centers. Now, the market obviously is choosing to treat that positively because if you're going to spend a lot more on capital spending, let me turn off my little phone here that seems to be moving around. So I was just saying that if you get all these companies saying that they're going to spend a lot more on AI, on NVIDIA chips, it's great for NVIDIA, but it is capital spending. It is a negative from profit. So we do want to see that all this spending is, in fact, having a very positive impact on productivity, on profit margins, and overall S&P 500 earnings. And that's what we're expecting. We're expecting that increasingly, when you look at the S&P 500, you'll be thinking that all these stocks should be thought of as technology stocks in that they either make the technologies, hardware and software that's relevant to increasing productivity and for themselves as well, or else they're companies that are using the technologies to increase their productivity. Eric, you're doing some work for us on the labor market and productivity for tomorrow's morning briefing.
Yeah. I mean, one of the premises that I'm kind of positing is that, we had a huge boom in labor force growth with a ton of immigration, and recent Census Bureau data kind of corroborates that. We had millions of immigrants coming. So a lot of the economic growth was we had labor force growth, and then we started to get productivity growth, and we're up to about as of the third quarter of last year, up to about 2% annualized productivity growth. As we kind of progress, there's going to be less immigration. There's already kind of clamped down on the border from Biden, and then the Trump administration is likely to continue that. So we're going to get slower labor force growth, but we think productivity growth could pick up to 3.5, 4% in the coming years. Part of that is high tech, but we're also going to have all these immigrants who came across the border, had a lot of language barriers. They lacked the skills to participate in our labor force. They're going to get acclimated and their productivity is going to rise. Plenty of research shows that in the 3 to 5 year period after an immigrant enters the US, their productivity improves. So we're going to get now labor composition improving. And then as workers get accustomed to using AI, automation, quantum computing, if that ever comes around, they adapt to the work from home and hybrid work environment, you get that total factor productivity. So we're kind of firing on all cylinders, or should be in the coming years in terms of productivity. It's a huge positive.
Yeah, and conceivably, some of the more rote menial jobs will be taken on by the immigrants, and that would allow people who had those jobs here to maybe trade up to better jobs, more productive jobs. So we'll see. So far, the data is suggesting that we are seeing a rebound in productivity growth from 2015 to the current numbers for the third quarter of last year. Went up from 0.5% at an annual rate to almost 2% at an annual rate. And so in some ways, our projection here isn't a forecast, it's an extrapolation. It's an extrapolation that what we're seeing will continue to occur. And so that would be a good thing. Eric, by the way, did you see the news that Trump and his advisors are talking about toning down the whole tariff structure that they've been threatening to impose?
Yeah, it's going to be, or at least speculatively, all countries, but only specific goods. So like critical minerals, I think medical devices, and like electricity and energy. So you can basically apply the tariff to everyone and kind of create some sort of win and encourage domestic manufacturing while preventing, like China circumnavigating tariffs through Mexico or Vietnam. Or wherever. So you kind of get the policy win and you prevent like the broad scale trade war. So, I mean, it's a positive. I think, it sounds good.
Yeah, a more thoughtful approach to tariffs is better than just kind of a wholesale increase in tariffs across the board. But I think the reason for the wholesale increase was an attempt to raise some revenues. And I think we did some calculation that a 10% tariff would bring in $400 billion at an annual rate, and a 20% tariff would bring in $800 billion at an annual rate, but it could also spark retaliation, trade wars, and unintended consequences. It could also be offset by a stronger dollar and a weaker currency. But now that there's this talk about the administration cutting back on their extreme versions of tariffs, the dollar's actually weakened on that somewhat. I would argue that the dollar was a bit overbought here, so I got no problems with the dollar weakening somewhat. There's a lot of work out there by people who believe that the dollar is doomed to lose its reserve status. I don't buy it. I know there's a lot of talk about strategic Bitcoin funds held by governments, but I don't really understand what that is, other than a government speculating on an asset class, cryptocurrencies. But what matters right now is the market is in good shape. The concerns that we and others had about Trump 2.0 and its unintended consequences at this point, if in fact they are having some discussions to tone down some of the proposals that Trump floated during the campaign, that would be a good thing. I did see, though, that Forbes came out just, I don't know, half an hour ago and said that Trump was denying that. So who knows? We'll see how that all plays out. Meanwhile, what we should also discuss, Eric, is the bond market. I saw the bond before we started was at 4.63%.
Yeah, it's definitely, I mean, been rising and decoupled from economic surprises, whereas we've had softer than expected data, but it's continued to rise, ostensibly on fiscal fears or worries of higher inflation. So, I mean, it's not like outside of its range. I think we're at, 4.25 to 4.75% is pretty normal, especially for the current economic trajectory and strong growth. But we'll see what happens, especially in the context of this week's labor market data, and get some more Fed speakers.
Well, for the market, if we've got the bond yield going up and the bond yield, let's say the bond vigilantes are correct and they put pressure on the Fed to stop lowering rates. I don't think the Fed's going to be raising rates, but clearly the signal at the end of last year that was that they're going to pause. And for the stock market, I think that's weighed on the broadening of the market. I think it's weighed on the SMID caps. It's weighed on the Russell 2000. Even in the S&P 500, we see that it continues to favor the Magnificent Seven. But the Magnificent Seven are in a magnificent position. They basically control the clickbait. Anytime the stock price goes down, all they have to do is say, Willow's even better than we thought in quantum computing. Now, I think, they never said, well, okay, where are we on the path to actually getting Willow to be part of a real operating quantum computer? And of course, that wasn't part of what they announced. And then again, we had Microsoft saying they're going to spend 80 billion instead of 50 billion this past year on data centers, and that had a tremendous impact on the market. Why don't we have a quick look at some of the charts, kind of a continuation of our discussion of what could go wrong and what could go right in the new year. On the what could go right side, we did start out the morning briefing with the January barometer and the January effect, and basically came to the conclusion that they're kind of irrelevant, and they're not even really worthwhile trying to trade, and it's certainly irrelevant for long-term investors because the reality is the market goes up over time since we have data. I mean, clearly a lot of volatility, but January effects just aren't really a winning strategy in any meaningful fashion. And one of the issues dawned on us was that, all right, so if the reason January tends to be a positive month for the year is that people sold in December to take some tax losses, then why is in December a down month? Why do we talk about a Santa Claus rally? This is a chart that our colleague Joe Abbott put together a while ago that we updated. You can say, sure, January is an up month on average, 1.17, but it's up 60% of the time and down 37% of the 37 times. This is a number of months, okay? But March is an up month, April. I mean, every month is an up month except for these three. And that's because the market tends to go up. So, just as Tony Sopranos used to say, forget about it. Let's move on then. So the good news is that the economy looks good. Bad news maybe is the bond market isn't all that cheered up about it. But the market's proven its resilience for the past 3 years. The Fed is no longer raising rates, it's lowering rates, so we don't have to worry about monetary policy causing a recession. We don't really even have to worry about geopolitical risks causing a recession because we've been there and done it, and the price of oil has stayed muted. And now all we have to worry about is tariffs leading to Smoot-Hawley. And I don't think either one of us thinks that that's the direction in which this is all going to go. So the outlook for earnings is pretty good. The fourth quarter earnings season is about to start. The analysts are expecting 8.2% increase year over year for the fourth quarter, the same as we had in the third quarter. You can see that the growth rate for the fourth quarter, the assumption has come down, and it's now the same as what we had in the third quarter. But we're thinking that we'll get another earnings hook, and that will probably be up at least 10% instead of 8.2%. You see, we've talked about these earnings hooks before that occur as analysts get conservative on stocks that they don't feel comfortable with. At least they get the messages from the losers. The winners like to keep that news to themselves until they announce it themselves and get the maximum firepower to the upside when they surprise with better than expected earnings. But at any rate, when the economy is expanding, we can pretty well expect that this will be better than analysts are expecting. In terms of the economy, we think that it's going to continue to show 2.5 to 3% real GDP growth. The fourth quarter right now is tracking at 2.4%. We think it's going to be 2.5 to 3%. The slight sign of life here in the U.S. manufacturing purchasing managers index. We're not above 50, but production and new orders are up above 50. So that's a happy development, I would say. Another happy development is, where everybody's staying up, waking up early in the morning. Well, I guess it's not, you don't have to wake up that early. It's 8:30 in the morning, New York time. You can watch, it's earlier for you, Eric, but I don't know if you get so excited about these numbers that you set your alarm to view them. But at any rate, the initial claims data, some people can say, well, December, it's a lot of holidays and things like that. So who knows what they're really saying, but they are seasonally adjusted. And as Eric, as I've taught Eric since he joined us, that when the data supports our story, it's good data. When it doesn't, there's something wrong with it. It'll be revised. So we like what we're seeing in continuing claims and what we're seeing in initial claims. Labor market looks pretty good. Eric, you want to tell us a little bit about these series? And I think you are also looking at these series for tomorrow.
I was muted. Sorry. So we have the JOLTS data coming out tomorrow. It's for November. Remember, it tends to lag the other indicators, but job openings in JOLTS, which are a very important series for a number of labor supply and demand charts and metrics, are very highly correlated with this blue line right here, jobs plentiful. So you saw a bounce in November and another in December. Part of that due to Trump 2.0. There's just more certainty for businesses once the election is over. It happens after every election, but also expecting a lower corporate tax rate, deregulation. We have more small businesses signaling that they're going to hire. And so, consumers are seeing more job opportunities. We should see that in the JOLTS data. And we're expecting to see it in the payrolls data on Friday for December. We had a big bounce in November, kind of murky because in October we had a hurricane and some strikes. Big bounce in November, which did beat expectations, but we think December payroll growth will be better than expected and should continue into the new year when we get the January data the following month.
Yeah, the logic is pretty straightforward, and that is profitable companies tend to expand. They tend to hire. They tend to spend on capital spending, and companies are definitely profitable. We think that when the numbers come out for the fourth quarter, S&P 500 earnings will be at an all-time record high. So, and the cash flow that we'll get when we get the Bureau of Economic Analysis data on profits also is likely to be an all-time record high. So, in our view of the world, it's profits that drive employment, drive capital spending, drive real GDP, and companies are definitely profitable, and they could very well get even more profitable in this roaring 2020s. Technology-led digital revolution with AI, with quantum computing, and so on. So that's where we're at. And then we haven't been watching this series. I know it's existed, and I don't know why I haven't been following it more closely. But we'll be watching this Red Book retail sales number, the year-over-year percent change. It's weekly data, and Eric, we have to figure this out somehow. The LSEG, which is the London Stock Exchange Group, they like to change it back to the British way of looking at the calendar. So this is 12/27, but 5.5% is a pretty healthy increase on a year-over-year basis. It is volatile, so But again, it supports our story, so we'll take it. The story being that consumers is strong. And of course, the consumers did respond to incentives by the auto dealers to unload their late last year models. And so here we had 16.5 in November. And I think it's the Ward's data shows that it got up to 17.2 in December. We prefer following the Bureau of Economic Analysis, but we'll certainly take Ward's as an indicator of what's to come in the BEA. But it looks like this is definitely going to be a positive contributor to consumer spending and GDP in the fourth quarter. Not so much will be construction spending, and what we are saying is the total construction spending has gone sideways, and part of that is because manufacturing structures construction all-time record high is flattening out an all-time record high. I mean, there is a limit to how high is high, and at some point you just kind of you started these things and you just keep building them at this high pace. That still means that construction employment is probably going to remain at a record high. By the way, just for fun, here's the chart that shows the S&P 500% change from 1980 to 2010. So this is 1980, and this is 2010. When you look at the red line, the blue line is 2010 to now. So we're right now ending. We're starting at 2025. So this would be 1995. And based on the way this thing's tracking, it looks like it's up, and away. We're going to have a great phenomenal melt up still ahead of us. There's only one little problem. This is the figure 16 is looking at the forward PE ratios. And the problem is that let's look at the forward PE, not the median. The forward PE is already right around 22. And back in 1995, we're more like 13. So we're actually pretty close to the top in terms of valuation. So we're bullish, but we're bullish, maybe it's wishful thinking, but we wish that the economy continues to grow. We don't really it's not a wish, we think it will. That's our forecast. And we think earnings will continue to grow. And we got S&P 500 earnings at $285 a share this year. I don't think any other strategist on the street's got a number close to our number. But then again, that's consistent with the roaring 2020s and the technology boom. So that's, I think, about a 16% increase. Depends on what this year will turn out to be. We think it's going to be $240 a share this year. The analysts are using 243, but it could be a 17% increase, which would be a nice way to increase the market on earnings. We wouldn't want to see the market continue to go up on valuation, but it's not up to us. And if it does, we'll have to consider raising our melt up probabilities. The Buffett ratio is, of course, off the charts compared to where it was back during this bubble, and maybe this is what Buffett looks at before he goes to sleep, and looks at again when he wakes up, and then when he goes to work, sells his stocks. Maybe he's really taken that to heart. Finally, we've discussed this many times. The issue of the risk that are out there that we've discussed. Trump 2.0. Maybe it seems a little less risky today, but Harris pointed out that Trump has denied the report of more selective tariffs, and we did along the way mention that, so we caught that as well, Harris. But there's the known unknown about where the Fed's head is at, and Eric's going to be doing some work on the fact that there's some of the Fed heads will now get a vote and some will lose it in the FOMC. But overall, we think they're going to be pausing, and we think they could be pausing for a while. But we'll take it from we'll keep going and stay on top of it. Eric, you want to field some of the questions that we're getting?
Yeah. So this one from Lee, kind of on what we mentioned about the dollar. So the dollar seems to be selling off on the tariff rumors. How important is a strong dollar to mitigate the bond vigilantes rate on T-bills? Aren't we hoping that foreign interest will keep a lid on yields?
It's a good question. You want to take it, Eric?
Yeah. I'm not entirely sure what's meant by the rate on T-bills, but I think generally yields are fairly low, all things considered. The yield curve is only up, a positive 30 bips. There's been a lot of foreign interest in U.S. assets, hence why the dollar is so strong. So I think even given this marginal sell-off, it's just
maybe that's it. They're just thinking that, if the dollar goes down, doesn't that indicate that foreigners aren't buying our bonds and aren't buying our bills? I think is
yeah. Yeah, no, I mean the dollar's still pretty strong even with this little correction. So if you had built in like dollar demand for a variety of reasons plus some tariff risk, the tariff risk coming off doesn't necessitate the dollar's weakening dramatically. So I wouldn't draw much off of it.
Okay, go ahead.
Okay, this is another one from Lee. Is increased productivity sufficient to offset the impact of government spending on inflation?
Well, there's so many moving parts here in Trump 2.0. I guess the short answer is we keep trying to remind people that the economy has its own dynamics, that it's not all about Washington. It's not all about monetary and fiscal policy. We've often expressed the view that we're very impressed by how well the economy performs despite Washington. And that's just our attempt to get people to stop obsessing about fiscal and monetary policy, the top-down approach to the economy, and appreciate more what we working stiffs are able to achieve despite the clowns in Washington. I think most of us are pretty much in tune with that because we look at stocks and we look at company managements and we see what companies are able to achieve in an environment sometimes where the government is hostile, or sometimes where the government and the corporations are cronies and are working together. So it's not all one way, but again, we think that especially the entrepreneurial capitalistic economy continues to thrive despite the fact that the government has gotten bigger and more regulations. But now that may be about to change. And by the way, it was likely to change even before Trump got elected because the Supreme Court in the Chevron ruling last year ruled that if you don't like a regulation that your regulator has imposed on you, you're running a business and you don't like the regulation, you can sue the regulator because if they don't have the direct specific authority from legislation by bill, law that's actually passed by Congress. So we're thinking that was a big deal right there and would have led to more deregulation as a result. But now we may very well put fast track deregulation with the Trump administration basically opening up a hotline to business and saying, tell us what regulation you don't like, and we'll probably get rid of it for you as long as you help us win the midterm elections and the next two elections. But that's beside the point. So deregulation, I think, and productivity are important disinflationary forces. By the way, again, we try to take the big picture view and have a balance between what people focus on and what people aren't focusing on. And I think we really need to focus on China. The 10-year bond yield fell below 1.6%. So the bond market there is telling the Chinese government the exact opposite of what the bond market's telling the U.S. government here. Over there, it's like, it's the bond market saying it's just whatever you're going to do, it's not going to work. You got deflation locked in. You screwed up in the past, and it's you're not going to make things any better. Go ahead, Eric. Let's take.
Just one thing from this morning on the topic of deregulation. Michael Barr, the vice chair of supervision, the basically head of regulation at the Fed, is stepping down, or he announced today, ostensibly on the back of pressure from Trump. He's kind of a hardliner. He was really pushing the Basel III endgame, which even internally, like Jerome Powell said, was too strict, and they're probably going to loosen. The Trump administration also is looking to fold in one of the regulators that's kind of under like Treasury control into another one to shrink the regulatory regime. We wrote a few months back about how the whole regulatory regime against big banks is kind of inflecting and going towards the downside or less regulation. That already looks like it's kind of taking shape. So a number of bank stocks up this morning It's just another kind of dereg piece of news. But let's take another one. It's from Cactus, and there's two questions on this. Happy New Year, Ed and Eric. Do you think the tax harvesting downside is in the rearview mirror now, or is that still a risk for a stock market correction in the rest of January?
Yeah, the risk may be over. I mean, it looks as though the momentum from on the tech side with Microsoft's announcement on Friday and the excitement about the Consumer Electronics Show and AI and rumors, anyways, that Trump 2.0 was being crafted, and it may not be as extreme as one would have thought, or at least we have to keep that as a possibility. It may very well be that the correction risk is over. But then again, the bond vigilantes have got our attention. And if we get some better than expected employment numbers, we could see the bond yield going up some. But yeah, I have to say that Friday's action, today's action, if people wanted to sell, they had the opportunity, and they haven't done it. The selling probably would have. I think the way I'd be thinking about the selling is if something else caused the market to go down, the tax selling would have exacerbated that. But now that doesn't look like it's a very plausible story.
We could take one more probably. This one's from Ted. Ed and Eric, the most common statement now is that the equity market's overvalued due to price to earnings. And his point is, it seems that earnings are growing faster than a few years ago. So when you look at the PEG, or the price to earnings to growth ratio, it looks like a much more reasonable valuation.
Well, we do look at the PEG ratio for the overall market. I don't think it's particularly relevant to specific stocks or sectors, but the PEG ratio, we use the forward PE relative to forward earnings. And yeah, that's nowhere near the kind of extremes it's been at the past. So there's something to be said for that when you use the forward numbers. But I don't know that the growth rate has really jumped off in a way that suggests it's anything unusually significant. Our pitch on the valuation has been that what justifies high valuations is the perception that the economy is going to have a long runway here, that it's going to, and then it's actually going to take off. Maybe I shouldn't use that metaphor; it doesn't work too well. But the idea is that the economy is just going to grow for longer than expected, and to the extent that the market's coming around to that view, it's starting to expect longer growth. That gives you more time for earnings to grow into the PE. Why don't we just take Gus's question, then we'll call it a morning.
All right. So Gus says some are talking about the current tariff proposal leading to another Smoot-Hawley scenario. Since we're large consumers of products today versus back in 1929, wouldn't that actually cause savings to increase and potentially be a positive for the U.S.?
That's an interesting spin. I guess our thinking is that we're not going to get Smoot-Hawley. We're not going to see a tariff that causes commodity prices to collapse and therefore lead to a big, huge banking crisis. We think a lot of it is for negotiating purposes, and will be crafted and fine-tuned along the way. So, even if they impose like a 10 or 20% across the board tariff, there'll probably be all sorts of exemptions that can be applied for. We've seen that in the past with steel tariffs, for example. But so all in all, we're not concerned about that. But we've said if monetary policy couldn't cause a recession, if geopolitical crises and couldn't get oil prices up and cause a recession, then maybe all that's really left to be concerned about is tariffs, and maybe that's just not all that concerning. Eric, thanks for doing this with me, and everybody, thanks for joining us, and we'll see you next week. Have a good week.
Thanks, everyone.